Joining us in a first on CNBC exclusive is Dine brand CEO John Peyton here at Post 9. It's great to have you. Welcome.
Thanks, Carl. Good morning.
I mean, one thing that stands out are just the year-on-year inflation statistics, even if you took out things like eggs and wheat, right?
Yes. So overall, inflation for cost of goods in the restaurants for us was about 20% for both brands in the first half of last year. When you look at Q4, IHOP was still about 19% because of eggs and wheat, and Applebee's is falling down to mid-teens and getting better as it progresses. So we saw the peak in pricing sort of midsummer, and we're seeing an easing as we move throughout the year.
Right. You've taken some price year on year, right? Maybe, 6, 7 points, depending on the brand?
Depends on the brand. So our franchisees are responsible for pricing. Applebee's franchisees nationally about 7%, IHOP about 10%. And that's still, that's half the cost of inflation. And it really reflects that our franchisees are very reflected on our brand's positions as value-oriented brands. And they really, I think, managed well their own margins, along with making sure we're still accessible to our guests.
We've heard from the likes of Walmart that there's a real trade-down that's happening, that households with higher incomes are going to Walmart to find better prices. Are you experiencing that? And as a result of having wealthier consumers, are you getting bigger checks?
So we're seeing some of that in terms of our guests this year. We're seeing, a little bit more at the higher income, a little bit less at the lower income, but overall about the same amount of traffic year over year. We've had the same average check each and every quarter throughout the year as well. So when you think about the price increases, what we can see is that our guests are managing through our menus and finding the value-oriented options like the 2-for price of something on our menus in order to, stick with us.
Are you ready to say, though, that you've taken as much price for the year as you're going to? We've had some, in terms of packaged goods, we've had some companies, Pepsi, for example, said, yeah, we pretty much have done what we're going to do for the year, but others like Nestle are not there yet.
Yeah, I would say this. So it's always important to keep in mind that it's our franchisees who make decisions about pricing. And we like where they are strategically in terms of taking about half of the increase in costs. And because we see the cost of goods sold easing, into this year, it puts much less pressure on them, right? So historically, they take about 2 to 3% a year in price. Last year, 7 to 10. We see them now on the path toward getting back to that historical run rate.
I want to ask you a very serious question and a not so serious question.
Okay.
The serious question is, when you take a look at all sorts of economic indicators out there, what is the one thing that you look at and you say, you know what, we might be seeing traffic go down, we might be seeing checks get smaller because we're witnessing this?
And that's a serious question.
That's a serious question. The second question involves shrinkflation, whether or not you've reduced the number of shrimp that you serve and the size of the chicken, et cetera.
The answer to the second question is absolutely
no.
not.
Okay.
So when you are a value-oriented brand, right, it's about good food, generous portions, at an accessible price, great experience. When it comes to the indicator for consumer behavior, gas prices.
Okay.
So, we did see a relationship between the increase in gas prices and traffic last year, and we see it, improving as the prices come down.
Finally, labor availability. We've been hearing anecdotally that I think Goldman had a great chart of the number of mentions of labor shortages peaked at 15%. A couple quarters ago. It's now down to 5.
Yes.
Is that directionally how you're seeing it?
It's a good news story for us as well. So we spent 5, 6, 7 quarters in 2021, early 22, stuck at 90% of staffing compared to 2019, and we're now approaching 95%. And so team members, employees are coming back to work or looking for jobs again, and we're more focused now on retention than we were on recruiting. So it's about flexible hours, flexible shifts, compensation, and things like that.
Wow. It's a far cry from where we were a couple of years ago, where
definitely.
Labor, COVID, we were in the midst of all of that. But it's nice to see it clear.
Our brands were resilient during those tough times. The value-oriented brands perform well. And, I think the most important thing is that American consumers want to invest in experiences. And restaurants and bars and hotels are benefiting right now from that COVID hangover.
Yeah, no, retail sales will show you that. John, thanks.